Amateur retail traders severely oscillate and struggle between two opposing emotions. To explain this, we're going to look at two traders. The first trader is Retail Robbie, and he represents the emotion of indecisiveness. Now, when you are trading and you're looking at the market, have you ever felt just a little bit of creeping doubt and then started to hesitate, wondering, should I enter the trade and get involved? Is it ready yet, or am I too early? Maybe I should wait a little bit longer for just a bit more confirmation, but I don't want it to go without me. Or maybe, have you ever struggled deciding how to manage a trade that you are in when you don't know whether to hold the trade or close it down and take what profit is currently on the table just in case it reverses against you? But then what if it continues going in your direction? Well, you don't want to miss out on all of that potential profit, so you hesitate and you agonize over what the right decision is. Because I know I used to feel that doubt and hesitation all of the time, where I was never quite sure what the best decision would be. And to be honest, it just used to make my trading so unnecessarily stressful. It just was not enjoyable at all, and it was starting to make me fall out of love with trading, really. Because it's only when you have the benefit of hindsight that you then realize when you look back, of course I knew I should have bought it. Or I knew I should have sold right there. Of course I should have held the trade. It was obvious it was going to keep going. Why didn't I just leave it alone? I'm an idiot. As they say, hindsight vision is 20/20. It's always crystal clear after the fact. Now, do you ever experience these emotions in the market, if you have been trading before? Because the majority of losing traders, or even those who are just struggling to find consistency, they are constantly fluctuating between those two poles of indecisiveness about the future and then regret over the past. And they're constantly hesitating and doubting and then being frustrated afterwards when they see the outcome of their decision. And they're indecisive because they're constantly trying to predict the future, but then they look back on the past with regret. So think of this as a swinging pendulum from left to right, with amateur traders constantly swinging back and forth between these emotions in the market. So how do you stop this back and forth rhythm between hesitation and regret? How do you transcend these two poles so that you can make your decision making as objective as possible? How do you get to the point, up the top there, where you have absolutely zero doubt or hesitation before making a trading decision, so that you never feel regret in hindsight after you have made that decision, regardless of the outcome of the trade? Because down here at the bottom of the diagram, this is where the masses play, the masses of losing traders, and up at the top is where the professional traders are. Those top 10%, the ones who are consistently making money year in, year out. So how do you get up there, where you have certainty in the market and you never feel doubt, hesitation, or regret? How do you separate yourself from the losing masses and become a consistently profitable trader? Do you want to be a hindsight trader for the rest of your life? I've been there thinking, I knew I should have sold there, but you know what, it's okay, I'll make the right decision next time. But then you're stuck in that cycle and you never quite seem to get it right consistently. And then that creeping doubt in your approach that you can feel deep down, it then never quite goes away. Or do you want unwavering certainty when you approach the markets every day? Now, I don't mean certainty in that you're going to win every trade. That's a complete fantasy, of course. I'm talking about having the certainty that you are making the correct decision every single time, with zero doubt or hesitation. So how can you be so certain that you are making the right decision ahead of time? Well, there are two types of trading strategies. The first type of strategy is called discretionary trading, and this is decision-based trading, where the trader decides which trades to take based on their own judgment and current market conditions. So as you can see in the diagram, from the starting point of analyzing a currency pair all the way through to actually executing an order, you will go through a decision-making process. Now, discretionary traders, they will make all of these decisions based on their own human judgment. Now, the major problem with this approach is that the more discretion you apply to your decision-making process in the market, then the higher the chance of you making emotional mistakes. So how do you reduce the chance of you making those emotional mistakes? How do you stop feeling doubt? How do you stop feeling hesitation? And how do you stop feeling regret in your trading so that you can be in that top 10%, so that you can be a consistently profitable trader? Well, if you can replace as many of the individual steps in your decision-making process with extremely clear, rules-based and mechanical criteria, then you will drastically reduce the chance of you making an emotional mistake. Now, the second type of trading strategy is what's called a mechanical strategy, which essentially is just rules-based trading. So instead of the trader deciding which trades to take based on their own human judgment, instead the trading system decides which trades to take regardless of what your human bias may think. So if you think about, programming your trading strategy into a computer algorithm, then you need to give it a series of binary questions that only have a yes or no outcome. So that essentially it follows an if-then process. So an event will occur in the market, you will then consult your plan to see if it meets your criteria. If it ticks the first box, then you move on to the next criteria. If it doesn't meet that criteria, then you simply do nothing and you move on. Otherwise, if it does, then you just simply work the whole way through until the setup has met all of your minimum criteria, and then you can just simply execute the trade. No doubt or hesitation. Now think of the market of a game like Pac-Man. I'm sure you're all pretty familiar with how that works. So each of these hollow circles, they represent a trading decision that you must make to progress to the next step. You have practically unlimited possibilities of getting from point A to point B in the markets. There is no map. It's down to you to choose your path. What entry signal are you going to use to enter a trade? Will you wait for a supply and demand zone to form? How will you define that that zone is valid? What type of order will you use to enter the market? Where are you going to place your stop loss? How will you manage your trade? Will you leave your stop loss open or will you move it to break even? Will you trade your stop behind price or set a take profit order or a combination of both? If you do trail your stop, how many pips behind price will you trail it? If you set a take profit order, where will you place it? On the next key structural level? How do you define a key level? How do you draw them consistently the same way every time? How many pips in front of that key level will you set your order? Are you going to scale in? Where and how will you scale in to add to your position? Okay, so I think you get the picture. There are many decisions to make when we're trading. So it's down to the trader to set their own parameters ahead of time with a clearly defined rules-based strategy. And this eliminates as many of the open-ended possibilities and it gives you that narrow course of action to take. So you simply make the same decisions over and over and over and over again. Having a mechanical strategy, of course, won't guarantee success on every trade, but what it will do is it's going to help you to manage your risk, minimize your losses, and nail down and secure your profits and handle unexpected events with decisive action, which over time will drastically improve your chance of success. By clearly defining your trading parameters ahead of time, you are establishing a basis for knowing whether your strategy and your edge, whether it's actually working or not. And then you can accurately, refine and optimize it over time. So let's look at two different traders. The first trader on top, they have a clearly defined systemized trading plan with very strict rules. There is a clear set of criteria that they tick off to make every single trading decision, so that they make the same set of decisions over and over again. Now the second trader, they utilize a much more discretionary approach. So they know they have a couple of rough styles that they utilize to trade the market, and within each of those styles, and they've got a lot of options open to them at each level. So they've got many different entry confirmations, just for the same setup. It's very open to subjective interpretation. Sometimes they trade from the 50% Fibonacci level, sometimes from the 0.618, sometimes they just use an EMA. They kind of just randomly pick where to place a stop loss of, where it looks pretty safe to place it. They'll use horizontal support and resistance levels, but they don't have a fixed systematic process for consistently placing them. They do not have a consistent mechanical method for identifying areas of interest on the chart that they consistently repeat with accuracy. Sometimes they'll try their stop, other times they'll just place a take profit order, but they place it in a different area every time. Sometimes they'll just manually close and exit a trade if it doesn't look right, whatever that means. Now, both of these traders, they both experience 4 losses in a row. Now, hitting 4 losses in a row is perfectly normal and expected, even if you have a strike rate of 75%, which is a really, really good strike rate. It's very likely that these losses are just simply part of the probability model playing out. But if you take 4 losses in a row, how do you actually determine if those losses are simply just a part of your probability model, or if you had made mistakes or just executed bad trades that you should not have taken? How do you actually determine that? Now, consistently profitable traders, we have a deep understanding of something called random distribution, right? And we know that the outcome of any individual trade is actually random. But on a collective basis, when you have a larger sample size of trades, just the exact opposite is true. If a large enough number of trades are taken, patterns will emerge that produce a consistent, predictable, and statistically reliable outcome. And that is your true trading edge. It's just logical basic math. There is no way around it. And do you remember the 2 layers of beliefs that professional traders hold? That on the surface, they do seem to contradict each other. And the first layer is the micro level. Remember, at this level, you have to believe in the uncertainty and the unpredictability of the outcome on each individual trade. And the second layer is that macro level, and at this level you have to believe that the outcome over a large series of trades taken is relatively certain and predictable. But here's the major key. Remember, it's the ability to believe in the unpredictability of the game at the micro level and simultaneously believing in the predictability of the game at the macro level that makes the professional trader effective and successful at what they do. They have learned and completely accepted the fact that they don't know what's going to happen next. No one does. But more importantly, they don't need to know in order to make money consistently. They don't care. And that's why they don't feel hesitation or doubt in their trading. So if we go back to our two traders, the mechanical and the discretionary trader, who both just took 4 losses in a row, which trader do you think is going to be sweating more? Which one is starting to panic and doubt their strategy or even begin to doubt their own ability? Who do you think is now more likely to be hesitant and make an emotional mistake? Who is more likely to skip the next trade out of fear or take a low probability or even random trade to try and make their losses back as soon as possible? Is it going to be the trader who can analyze those 4 losing trades and clearly see if those trades met all of the defined criteria of their strategy, who can then see that those losses were actually just in fact valid trades that are a part of their strategy, and therefore those trades are a part of their probability model, and those losing trades were simply a cost of doing business? Or will the panicking trader be the one who has no real idea if those losing trades are a part of their probability model, or if they were simply just bad trades that should never have been taken and those losses could have been completely avoided? I think it's pretty obvious that the discretionary trader with that subjective approach is the one who is most likely to be feeling those negative emotions and is therefore most likely to make an error next. Now, obviously, without a reference point based on clearly defined and sound rules, you have no way to measure the outcome of your trading decisions, and therefore you have no real idea if things are going along as planned or if there is a real reason for concern. You need to eliminate the variable that is you, and the only way to do that is to make consistent decisions that can be measured. Now let's put some numbers on the situation so we can see exactly why this is such a major issue for losing traders. So after those 4 trades, both traders are down, let's say minus 4%. Now when the systematic trader looks back and they review their trades and then they see that they followed their plan perfectly, they ticked off every single criteria in their trade plan, they're going to have way more confidence to continue to execute with minimal emotional interference. And they take the next trade, which is a 5% winner, and they see their edge playing out. But the discretionary trader, they've been doubting and hesitating after taking those losses, and they can't face the pain of another potential loss, so they skip their next setup and they miss out on the winner. Now that they see their trade play out, they're frustrated they missed it, but they have a bit more confidence, so they execute the next trade and they catch a 2% win. Now, you can see after those 6 trades, the trader with a systemized approach is sitting on a net 3% profit, while the discretionary trader is down minus 2%. And this is what I see happening again and again with so many traders who are just struggling to find real consistency and stop doing the break-even dance. Because when the mechanical trader, when they review their trades and they look back and they see that they followed their plan perfectly, they're not going to hesitate or doubt their next setup, and they're the ones who are going to catch their next stream of profitable trades and march onto new account equity highs. But whilst the discretionary trader, they're just going to keep digging themselves into a deep drawdown, or maybe just continue playing that break-even game for years and years, never really going anywhere, wasting their time, energy and money. Hesitation kills traders. Once you have a mechanical and a systemized strategy, the level of emotion that you will feel in the market after just taking a few losses will be drastically minimized, and you will then be able to execute with ruthless decisiveness and extreme clarity. No one likes losing, obviously, right? But imagine for a second a world in which you do enjoy it. How is that possible? Well, when you do have a systemized edge, as long as the losing trades perfectly met your strategy criteria, then you know that each loss is bringing you one step closer to your next profitable run of trades. Now, I used to struggle so badly with this before I changed my strategy, where I would take a few losing trades, but then because I didn't have an extremely systemized approach, I would start to doubt and hesitate my own ability, so then I would naturally skip trades because I couldn't face taking another loss because I wanted to quit my job so badly, so I wanted to become a full-time trader. And then every single loss that I took, Each loss felt like a direct threat to my plans to try and escape my 9 to 5. But then because I skipped trade setups to avoid that potential pain, I would then inevitably miss those winning trades. And then after feeling the pain and the FOMO of seeing those winning trades play out without me, I would then revenge trade by rushing into poor setups, which I'm sure you can guess, of course, would just end up losing me more money. So then I was stuck in this never-ending death loop, which was feeding off itself because I was just so desperate to make it. But all I had to do was simply change my approach to break out of it. Not having a proven defined edge is very likely the root cause of most losing traders' problems. Because if you were playing poker, would you bet on a hand if you couldn't see your cards? Of course not. Why on earth would you do that when you can't see what edge you have? You have absolutely no idea what probability you have of winning. It's just pure gambling with zero edge. But so many traders in the markets are essentially betting on hands when they don't even know what cards they are holding. It's insane. Do not be a blind trader because you do not have to be. Having a very discretionary and subjective approach to trading is tough in your psychology. It's very easy to second guess any decisions that you have to make in the market, but it's also extremely hard to accurately test and journal your strategy. Because how can you have any certainty if a trade is actually valid or not? People can overcomplicate trading, but we know that the path to success is very clear. You must have a systemized strategy that you can consistently execute and easily test. This way that you can prove your edge with data. And then once you prove it with cold hard data, that is the only way in which you will have a bulletproof mindset. And once you've developed that bulletproof mindset, you will then not make those emotional mistakes. Because it's only once you cut out those emotional mistakes and those slip-ups that you will then start to enjoy those consistent results that you desire. Because then you have a sustainable strategy because you're executing the same crystal clear setups again and again, managing the trade the same way every single time. And that is when you actually have the solid foundation built upon which you are now ready to rapidly scale, acquire investor capital or funding from a prop firm, and you can very quickly scale to multiple 6, 7 or 8 figures. The sky truly is the limit. Many traders moan that, it's the lack of capital, which is the reason why they're not having any success. But let me ask you this. If you were given a £1 million trading account today, are you ready to comfortably trade it? Be honest with yourself. Would you be able to confidently risk £10,000? So that's 1% risk on a £1 million account, right? Would you be able to confidently risk 10 grand on the next trade with your current strategy, with extreme confidence and clarity in your approach? Because if you're not, then you will never be able to scale until you have extreme confidence and clarity in your proven edge. To be able to eliminate any hesitation and doubt when you're trading, so that you can act with ruthless decisiveness, you must have a consistent, repeatable, and scalable approach so you can snap out of the break-even dance and start to rapidly compound your growth. You see, all trading strategies fit somewhere along this scale, from 100% discretionary, where the trader literally has zero framework but just decides with their gut instinct, all the way up to 100% mechanical, where you can literally use an algorithm to execute the strategy for you. I personally think that the sweet spot for trading is around that 70 to 90% mark. And this is where you will enjoy all of the benefits that we have just discussed from having that mechanical and sort of very systemized approach, but it will also allow you to avoid some of the drawbacks of being 100% mechanical, because you still need a little bit of room for human judgment. And it's actually that small element of human judgment that is required that actually gives us an edge over algorithms. And that's why algorithms, they tend to, they can work really well in the short term, but they nearly always eventually blow up unless they are constantly tweaked and refined by human input. The market is a dynamic environment, which is always constantly changing, so we need to adapt with it. So how can we make our strategy mechanical? Well, there are 4 main areas that you need to fix. First being trade entry, the second being stop loss placement, the third being your trade management, and the fourth being risk management. So now we're going to get nice and practical, and we're going to dive into each of these 4 areas to kind of look at how we can make them more mechanical and systemized so that you can start getting results. So trade entry, you must enter the market the same way consistently every single time. So essentially, we always look to enter on supply and demand zones, right? Okay, sounds pretty simple. But what type of order are you going to use? Are you going to set a limit order? Or are you going to wait for price to enter the zone and then hit an instant market order? What time frame are you going to use for your entry execution? Are you always going to use the same time frame for entries no matter what, say such as the M1, or are you also happy to use the 15 seconds, as well? Or maybe you just want to use risk entries on the M15 zones, for example. Whatever you want to do, just make sure you define, which time frames are valid for you, and if it is more than one, and in what circumstance it is valid to use another time frame, just so you're not constantly jumping all over the place. Are you going to only use flip zones, or are you only going to use structural zones? Or maybe you're going to use both, so you're going to use zones that cause flips and break structure. Does it need to be a sweep zone? So does the zone need to take liquidity when it was created? Does the zone need to have inducement in front of it? Does your entry zone need to be in the premium if you are selling? Or does it need to be in the discount if you are buying? And if so, what time frame are you going to use to determine if you are in the premium or the discount? For example, you might be trading M15 POIs, right? M15 zones, but you're using the M1 for execution within those M15 zones. So you might use the M15 range to determine if price is in the premium or the discount. Now, when you draw your zones, are you always going to take the entire buy to sell or sell to buy range? Or will you refine to a pivot or a single candle or even a fractal refinement? Where on the zone are you going to enter? Will you enter on the distal, the front edge of the zone, or will you always enter on the EQ? Or will your entry depend on how big your stop loss size is instead? You must be as specific as possible because there is no other way to be consistent with your approach. So just make sure that you don't leave any details out. So the second key area to look at is your stop loss placement. So you need to develop a fixed formula for consistent placement. Now there's multiple ways of doing this, like anything in trading, but we always place our stop loss behind the supply and demand zone that we enter on as an absolute minimum. But what I would advise is that you define the exact number of pips, that buffer that you want to give your stop loss behind the zone. Just to account for spread, and sometimes if there's slight spikes of the zone, just to make you kind of consistently do that way every single time. So it could even just be half a pip, whatever. It obviously will differ on kind of what time frame you're on and what pair you trade. So you can also use a fixed stop loss for each individual pair you trade. So let's say with euro dollar, once you've obviously tested your strategy, you may find that over a large sample size of trades, that actually 3 pips is the most optimal stop loss size to always use. But then maybe for a pair like pound yen, which is typically quite a bit more volatile than euro dollar in terms of its average true range, which just means in terms of how many pips it moves a day, you may find that 6 pips is actually the most optimal stop loss size. So now you have a fixed, mechanical, consistent way of sizing your trade every single time, leaving no room for uncertainty or hesitation. And a final way is just to use a fixed stop loss behind a swing high or the swing low. So instead of just protecting your stop behind the entry zone, you may also want to cover the actual swing point. Just in case price pushes further towards the extremity of the zone, you might increase your odds of actually staying in the position. Obviously, this will probably likely sacrifice your risk to reward a little bit, but it may boost your strike rate. But just again, make sure you define how many pips behind the swing that you will place it. And of course, this could differ from pair to pair and what time frame you're actually entering on. Now, once you have a fixed method for stop loss placement, it's obviously going to be far easier on your emotions at times where you might only literally just be stopped out by even a micro pip before price then reverses in your favor. But then instead of looking back in hindsight and saying, I should have just had a slightly wider stop, and then sitting there counting all of your missed potential profit, instead you will be assured in your approach because you followed your plan perfectly and consistently. Now, of course, if you find you keep only just getting stopped out, then you know exactly what part of your plan then needs refining and optimizing, and it makes it really easy to adapt and improve your strategy because you have that consistent approach that then you can look back on and just tweak that little bit, right? And obviously you can't do that when you have a subjective and inconsistent approach to placing your stop loss. Remember, we are trying not to be hindsight traders. So the third area is trading management. And if you could hypothetically only make one area of your trading strategy mechanical, then this would be it. Now, why do I say that? Well, it's because of after working with many traders, I've seen that a lot of them, they have the ability to pick out and enter really, really great trades. But what separates out those who get, those great returns are the ones who can consistently manage those trades well. So once you have entered a trade, obviously your emotions are going to be pretty high because you now have your capital at risk, and wherever money is involved, we tend to make quite irrational decisions, right, as humans. So if we have that mechanical management strategy where we can simply just follow the plan like a robot, then this can help to eliminate any room for those potential emotional mistakes. And also, there's no room to be annoyed if price continues on further after you've actually executed your trades and exited, because you know that you're going to manage the same way every single time. So it helps you to eliminate that feeling of greed and dissatisfaction in the short term, because you will see the long-term benefits from that consistent management approach. So what are some of the ways in which we can do this? Well, we can use a fixed take profit order based on a risk to reward ratio. So for example, you may trade a fixed RR of 10 to 1, where you use no active management. So you are either stopped out for a full loss or price hits your target. Or maybe you want to move your stop loss to break even only once price has reached 5R running profit, for example, right? So you can start to get a little bit creative here. Now, the way that you would calculate your actual profit target is you take your stop loss size and then you obviously multiply it by whatever your chosen reward to risk ratio is. So let's say your stop loss was 5 pips and then you're targeting 10R, you would then set your take profit order 50 pips away, right? 10 times 5. Now, another way is setting your take profit order on a key level. So you can target an unmitigated supply and demand zone, or maybe a weak swing high or low, or any obvious liquidity points in the market where we expect price to pull back or reverse. But again, you must have a mechanical way for drawing and identifying your key levels on your charts for this to work. Now, the other way, which is one, as you guys know, I wouldn't really recommend personally, but you can actively manage your trade by trailing your stop loss behind the swing highs or lows and just simply following the trend. So this way, in theory, you should be exiting on the trend change, right? But as always, you must be extremely specific. So how many pips in front of your key level will you set your take profit order? How many pips behind the swing high or low will you trade your stop loss? What time frame are your targets going to be based on? Are you targeting the 4-hour swing high or low, or just the M15, for example? Or are you going to use both? If you are going to use both, then you need to define in what situations you are targeting the 4-hour and when you will just use the M15. Or if you're using partials, how much volume are you going to partial at each of those levels? You don't just want to be doing this, kind of based on your gut feeling when you're in the trade. You need to have this all laid out and written down before you're even looking at the charts to trade each day. Now, the final main area to look at is one that I think many traders don't really spend too much time considering, and that is risk management. Because professional traders, they understand random distribution, right? That no one knows the sequence of their winning and losing trades, so they always keep their risk constant. So make sure that you are always using a fixed position sizing, risking the same percentage of your total account balance on each trade. Define how you will scale in. Will you only do it once the risk of your initial position has been removed? How much will you risk per day? You can define this by the max percentage of your total account balance, and then the same for your total open risk. So this is how many trades you will have running at one point with stop losses fully open. So just make sure you define all of these ahead of time and you consistently use fixed risk. So to summarize, if you enter the same way every time, you use a fixed formula for stop loss sizing, you manage your trades like an algorithm, and you use fixed position sizing, then fixing these elements of your trading, it will allow you to accurately measure and optimize your strategy performance. Only when you have a clearly defined strategy can you actually identify the bottleneck and then fix, tweak, and improve your strategy. It's how you can adapt to the constantly changing market environment and actually stay ahead of your competition in this zero-sum game. If you want consistent results, but the market is random, then be consistent in what you can control and be a slave to your strategy. You don't need to try and predict the markets. You just have to try and be in the markets every time a high probability trade setup by your plan is provided.